So what is my investment strategy in 2022 and moving forward? Well, in my margin account, I'm definitely gonna continue selling options, even though I've been losing a lot with options selling, but I still believe in the concept, and I'm gonna continue until I can make it work. I'm really insisting on making it work, and I'm learning a lot. What I'm learning is I'm no longer gonna be rolling or trying to save a trade. For example, if I sell a naked put and it gets breached, I used to roll it. But after what I've seen in the past year, rolling can be very dangerous. For example, imagine if you were rolling Zoom. Now, a year ago, it was trading at 280. Now it's at 72. Now, let's look even further. It used to trade almost at 600. Imagine if you sold an out of the money naked put on a red day, and you ended up with a put, I don't know, let's say at 500, and then it just continues to drop like that. There was no amount of rolling that would save you from this trade. So what would end up happening is you'd run out of buying power just to keep rolling this trade, and then you might get into a margin call, and then you'd be forced to close the trade for a big loss. So I'm definitely focused on shorter term trades like earning trades and zero DTE trades on the SPX. Earning trades, for example, last week Domino's Pizza had earnings, and as you could see here, it jumped after earnings. So an out of the money naked put at expected move would have been a winner. I think it was around $3. Another stock that had earnings last week was BlackRock, so BLK. I was looking at the $500 strike. It was for $4. Now after earnings, they dropped a little bit, but then came back up, so it would have been a winner as well. So that's $7 profit there, or $700. You had Pepsi as well, that was a winner. Although premiums or volatility on Pepsi isn't so high, so premiums were kind of low. I think it was like 80 cents to sell a put at expected move, but still a winner. You had JP Morgan, which was also a winner. I think the strike at expected move was paying about $1, so another winner as well. And you also had UNH, United Health. This one was a winner as well after earnings. I think I was looking at the 490 strike, I believe, and it was paying about, I think, between $2.50 and $3. And it would have been a winner as well. All the stocks that I was looking at last week for earnings, they would have been all winners if I had just sold an out of the money naked put. Now, I definitely know it's not going to be the case every time, but as you can see, most of the time, it's an easy winner. So in my margin account, I'm going to continue to sell options, earning trades, naked puts on earning trades, and naked puts on the SPX every day, 0 DTE. With a stop loss. So let me explain that trade. So SPX or SPXW with Questrade, if I want the weekly option, it has an expiry every day. Every day of the week, it has an expiry. So what I like to do is I sell this every morning. I'll sell the put that pays $5. It's usually a little bit outside of expected move strike. So I'll sell the put that pays $5 close to the open. I don't try to be selective. I just sell the put that pays $5, but with a stop loss. So if I sell for $5, close the trade if it reaches $15. That means I take my loss at $15, and that means I lose $10 on the trade. Or if the trade is a winner, I close it for $1. So either I take profit at $1, or I close the trade, or I take loss. I stop my loss at $15. So it's a bracket order that looks like this, basically. So I enter the trade for $5. I sell, let's say, the 3,500 put October 17 for $5. And I take profit at $1, as you can see here. So it's a bracket order, take profit at $1. And I stop loss. Basically, the limit order to take the loss gets triggered when the value of this option reaches $15, but then my limit price is $15.10. So basically, I'll be taking loss at $15.10. So this is what the order looks like. Sell to open for $5, buy to close for $1 if it's profitable, then buy to close, stop, $15, $15.10 limit. As you can see, it takes a lot of buying power. It takes about 45,000 US, but it's a trade that's closed at the end of the day. So then I get my capital back, but made $400. If it's a winner, I made $400 in a day. And this is why I wanted to open an interactive brokers account, because if I don't have the buying power to do a naked put, I could do it as a spread, a wide spread that will take less than 45,000 buying power. But Questrade doesn't allow bracket orders on spreads, but Interactive Broker does. So I could do the bracket orders on spreads with IBKR. I've been trading the SPX, or if I'm not trading it, I've been paper trading it for sure every day since May 18. So I've got about 103 occasions that I've been paper trading, or even traded with real money. I've probably traded with real money maybe 6 times or 7 times since May 18, but I've been tracking it every day, even if I'm not actually trading it, and tracking it as realistically, as if I were going to enter the trade. The first strike at the open that pays $5, and I see at the end of the day, did this strike reach $15 first, or did it reach $1 first? So out of 103 occasions, 17 occasions were losers. So minus 17. And that means 86 were winners. So 86 times $400 minus the 17 occasions that were losers. So that's about 17 times 1,000. So minus $17,000. So that leaves me with a profit of $17,400, and that is since May 18. I'm recording this video October 16. So let's just round it off to exactly 5 months. So this strategy would have generated, if I had done it for real every day, would have generated $17,400 in 5 months. So divided by 5, that's exactly, or that's on average $3,500 US per month. Now, some months are better than others. The last 28 days are not good. The last 28 days, I have 21 winners and 7 losers. So 21 times 400, that's 8,400 minus 7 losers, which is 7,000. I'm left with 1,400 in 28 days. So that's probably around $1,000 in the month. So it's not as good as the average for 5 months. So some months will bring up the average, and some months will bring down the average. So that's what I'll be doing in my margin account. Now in my TFSA, I'm going to be buying dividend stocks, but dividend stocks that have a really good yield, and dividend growth stocks like TD or Manulife, not the covered call ETFs that generally go down over time. I used to like DFN, if you remember, I used to like DFN.to, but then I realized that, even though it pays really high dividends, but just look at the chart, it just over time, it just keeps dropping. Unless you buy it at the perfect time, but over time it keeps dropping, even if they pay almost, I think what they pay 15%, 18% dividends per year, you're losing a lot from the capital depreciation. And not only that, if they ever close the fund, you don't know necessarily what you're getting back, because it all depends on the net asset value at that time. I'm also going to do covered calls on stocks that I think have reached the bottom. I could be wrong, but look, I bought Meta. I bought 100 shares of Meta. Average price is 140. It's at 126 now, but I'm selling out of the money weekly covered calls on green days. That's what I'm doing. This way I get some capital appreciation and I get some income from my position without losing my position. I don't want to lose my position, because Meta could drop to 100, it could drop to $80. So I don't want to be selling, I don't want to be losing my position at $80. But I want to generate income from it. So as long as I'm able to sell out of the money calls on my position, even if it's below my cost basis, but just sell it on a green day just to increase my chances of not getting called away or not losing my shares, then at least I'm generating income while I'm waiting for the position to come back up. Meta has been completely destroyed. It's actually below March 2020 prices, and it's got a very low PE ratio. If we look up Meta here, META, PE ratio of $10. Facebook trading at a 10 PE ratio. And look at March 2020 was trading at around 149, and right now it's at 126. So it's even below March 2020 price. I don't know if it's going to keep going lower, but it definitely looked attractive at this price. And that's why I bought 100 shares. But what I did is I had BABA shares and PayPal shares, 100 shares each. So instead of holding on to them, I replaced them. I replaced them with Meta shares. I'd rather hold Meta shares right now than to hold Baba or PayPal shares. So it was just a replacement of position. But because I was down a lot on Baba and PayPal, I can't lose my shares. I can't sell Meta at 140. I have to wait till it comes back up so I can make up for the loss on Baba and PayPal. So it has to go up maybe $200 or $300. While it's going up, I'll be selling, hopefully, weekly out of the money calls. So I've been already selling weekly out of the money calls. I've sold 2 already. So I sold one for 90 cents and I sold the other one for 88 cents. So already about a dollar. Well, let's see on average how much that gives me. So let's say 90 divided by whatever it's worth right now, divided by 127. Sorry, let's do this again. So 90 cents divided by 127 and then times 52 to see the annualized rate. So that's about 36% yield on this position. Now, I know I'm not going to be getting 90 cents every week, but this is just an example of how I would calculate it. Some weeks might be 50 cents. Some weeks I might be rolling it for a debit. That will happen if the stock flies one week and goes past my short call and I don't want to lose my shares. So I have to roll for a debit or a very small debit or even a very small credit. So what else do I have in my TFSA? I bought some FedEx when it dropped hard after earnings. I've got Intel, but I've had Intel for a while and I'm just dollar cost averaging. I mean, it's a good dividend stock. It's paying, I think, 5% dividend yield. I've got Lightspeed. This I started off as a covered call. I don't mind selling it. I'll just keep selling it. I'll just keep selling calls until I get called away. I've got Nvidia. So I want to do covered calls on it, but I'm slowly buying shares of it. But it's just another one that keeps dropping. But definitely, I'd be comfortable having 100 shares of Nvidia and selling out of the money weekly covered calls on it as well. Spotify and Zoom as well. I would be comfortable buying 100 shares, but not right away. I'll do it slowly. I also want to make sure I have enough cash to keep buying in case the market continues to drop. I don't know how further this market will crash. So I want to make sure that at least if market drops another 50%, let's say, that I still have cash to buy some more. Because it's great that the market's crashing, everything's on a discount, but it's not going to be great if you don't have the cash to buy, right? So it's important to leave some cash on the side so you can take advantage of these low prices and not panic that the market is crashing, but on the other hand, be excited that the market is crashing. So in my RSP, I'll be doing the same thing as in my TFSA. I've cleaned up a few terrible positions. I took some losses. I realized some big losses in my RSP, but there's no point. I would not, if I had the money right now and I didn't have the positions, it's not positions that I would be buying. So there was no point holding on to them. Instead, I'll buy some stocks that I prefer. I'm going to do some dividend stocks and also some covered calls. Right now, I've got a bit of AMD. So this is not dividend or covered call, but just more like capital appreciation because it dropped a lot. Maybe eventually I can dollar cost average to do covered calls. I've got JEPI here for dividends. Lightspeed as well was covered call. I've got Manulife for dividends. Now, I remember Manulife at some point was at $24. It was showing like a good profit, but I didn't sell it. I wish I sold it because I could have made the capital appreciation and then bought it back right now when it dropped below my cost basis. But I got Manulife for dividends. I think it pays almost 6% dividends. I've got Triple M for dividends as well. I've got Pinterest. This is an old position that I'll probably be selling. I'm just selling calls on it every week until I get called away. So Pinterest and Peloton, just old positions that are doing terrible, as you can see over here, the open P&L. I'm just selling covered calls on them until they get called away. QYLD, I bought a bit for dividends as well. Now QYLD, I know also doesn't go up in the long term, but because it dropped so much, I felt like I thought it would be a good entry. I've got Rio for dividends as well. This one at some point was very profitable. I could have sold at $58 or $59. I didn't. Got Shopify for covered calls eventually, not right now. I only have 50 shares. And Zillow is an old position that I will get rid of. I'm just selling covered calls weekly until I get called away. I used to have Snapchat as well, part of this position here, Pinterest and Peloton. and it got called away, and I just didn't feel like buying it back. There's no point. And finally, in my RRSP, I sold all my positions. They were terrible. I could probably show them to you over here. So remember, good old Wish here. I think my cost basis was $13. I sold it for 85 cents. Fubo here, I don't remember my cost basis, but sold it for a loss for sure. Corsair as well, and SoFi as well. And then the same day I closed it, I bought a SPY option just for fun, just one contract, because I had a feeling this market would drop. It was like I bought it October 4th for October 7th expiry, so like a 3-day trade. I bought it for $268. My initial plan was to hold it at expiry no matter what. I wasn't able to do that. I ended up selling it for $378, so $110 profit. But it was worth about, I think, $11 at expiry. So I should have held it. I would have made way more if I just stuck to the plan initially, but I couldn't. Instead, I just bought some Intel, some dividend stocks. So a good yield here. Paying almost, I think, 5 or 6% INTC, paying 5.5% yield, so pretty good. Plus, it's got room for capital appreciation, even if it's losing market share. I still think it's definitely under or oversold, because look at the PE ratio, $5 PE ratio, come on. Just wanted to share with you my investment strategy moving forward. Don't forget to check out the links in the description below the video to help support the channel and to take advantage of some referral promotions. So Questrade, Interactive Brokers, and so on. Thanks for watching.